Welcome back to our financial management series. I'm Gokul. I'm working as an assistant professor in the Department of Master of Business Administration in Sri Kumar Institute of Technology. In this part two of Unit 2, investment and capital budgeting decision we are going to see. In the previous part, we learned what capital budgeting is and why it matters. Today we will explore the different types of capital budgeting projects and the key factors that will influence these decisions. In this session, we will cover project categorization, the various types of capital investments, and steps in capital budgeting, like key factors considered in capital budgeting, then factors influencing capital budgeting decisions. Let's begin with how projects are typically categorized. Capital budgeting, project categorization. Capital budgeting projects come in many forms. Here are the common categories. First point, establishment of new product or services means investing in new product lines or services offering to a market. Then second, replacement projects, replacing or worn out equipment either for maintenance, keeping operation running, or cost reduction. It was most efficient technology used in the firm's office. The expansion of existing projects, it gradually increasing capacity of current operation to meet growing demand. Then for research and development projects, investment in innovation, new technology or product improvement have to be taken considered while running a firm or while doing some projects because we are giving the same type of product for multiple years means the customers may not be able to accept the product. In the modern world, in the increasing technology, we have to develop our projects which will be useful for the customers so that we have to innovate some new projects or new product or we have to improve the product by giving some new technology in the world so that the R&D department is must work. So they will do some projects like investment in innovations, new technology or product improvements. Then with the long-term contracts, commitments to supply goods or services over extended periods, requiring upfront investment. Then cost safety or environmental projects, mandatory investment to comply with regulations or improve workplace safety. Each category has different risk profile and evaluation criteria. So we have to follow all the categories because if we miss one category mix, there will be some minor changes in the company or there will be some back-end problems. So we have to follow all the category. But there is a different risk in each category. We have to take consider while doing about the projects or while taking about that category. Then steps in capital budgeting. There are 8 steps in capital budgeting. Let's revisit the steps now in the context. Identify investment opportunities. Second, estimate cash flows, which includes both outflow, cash outflow, and cash inflow. Third, evaluate risk. It access uncertainty. Then fourth, apply decision criteria. It uses the techniques like NPV, IR, AR, payback period, etc. Then select projects based on the analysis. Based on the analysis only, we have to select the project because we want some enough money to invest in the projects. So Depend upon that money, we will we'll do some analysis, and then we will invest in the projects. We will select the project, then implement and monitor. It was track the performance of the projects. This disciplined approach ensures consistency in decision making. Then factors of capital budgeting. Three fundamental factors underpin every capital budgeting decisions. First point, net investment. Second, net return. And third, cost of capital. Net investment means the initial cash outlay required for the projects. Net returns, the expected future cash inflows from the project. Then cost of capital, the minimum return required to satisfy the investors. These three elements form the basis for all evaluation techniques. Then factors influencing capital budgeting. Beyond these four factors, many external and internal elements influence capital budgeting decisions. First is availability of funds. We can ask the question like that: can the company raise the needed capital? The second, structure of capital. The debt equity mix affects cost and risk. Third, taxation policy. Tax rate and the incentives may impact net returns. So we have to take consider of the tax also. Fourth, government policy. Regulations, subsidies given by the government have to be taken consider, and the industry priorities for some industry government have given more priorities because they that may be the essential for the peoples. So they will give some priority for the particular industries. Then lending policies of financial institutions. It's a ease of borrowing. Then earnings. Uh, Earnings means projected profitability. Immediate need of the project is urgency can override other factors. Then capital return. The expected rate of return which we are getting from the uh, company's business. Then economic value of the project, strategic value beyond numbers, working capital. It impacts on the day-to-day liquidity needs, accounting practice, how profits are reported. Accounting is the main process in the capital budgeting because we are getting money from the bank, financial institution, or the shareholders, or we are spending our own money, or we are getting the credit, or we are getting the capital from the some other people's means. We have to pay some interest to them. So that's the rate of return. So for that, we need to do some accounting practice while dividing the profit. We have give the rate of return for the banks or financial institutions or for the uh, some other people who have given money to the company for the business point of view. So we have to take consider of the profit and we have to do some analysis because all the profit should not be distributed to the shareholders or the banks or the financial institutions. We have to take some of the money and we have to keep it as a retained capital limits. Uh, why? Because for the next year or for the next project, we need some money to run the business. So we have to take consideration from the project and we have to take some of the money and we have to keep as a capital retained limit so that we can run the project or business in the continuous flow. There will not be stuck in the business. Then trend of learnings, its consistency and the growth potential. A good finance manager consider all these factors holistically because all these factors are very important for the capital budgeting. That concludes part 2 of Unit 2. We have seen the diverse types of capital projects and the many factors that will influence investment decisions. In part 3, we will dive into the specific techniques used to evaluate these projects like payback period, LTV, and year. Thank you for watching. If you have found this video helpful, means kindly like, share, and subscribe to the YouTube channel so that you can see the many videos for the upcoming units. If you have any questions, drop your questions in the comments. See you in the next part. Thank you.